Trading is a game of controlled risk taking. The difference between a new trader or somebody who's not really uh, experienced in this field or not profitable is they're, they're not really in the game of controlled risk taking. Good traders who have been around and those who have been profitable for a long period of time, do a damn good job of controlling the risk. So, controlled risk taking, or CRT as we call it on the Stockbee side, is an approach to trading. And how do you control risk? Control risk taking is a function of uh, you finding out the market conditions, and then according to the market conditions playing a setup which is suitable for that market conditions, or essentially varying your risk according to the market conditions. There are times when you can take large amount of risk, even use margins to enhance your returns, and there are times when you have to be very cautious. Controlled risk taking also involves you basically deciding some sort of a timing model. Like I have a timing model, and in my timing model, I'm looking for stocks which have, or I'm controlling, like I'm looking for every day uh, the what is the market breadth, and depending on the market breadth, I decide my strategies. So the most important thing from my point of view for controlling risk is these two columns. When these are red, or when the number of stocks down 25% in a quarter is more than stocks up 25% in a quarter, that is a time when there is very high risk of big drawdowns and big losses. Can you make money trading during this time? Yes, but you have to be tactically very nimble and very agile during this time period. There are periods during which time period when shorting works, but at the same time there will be counter trend rallies, and during that particular counter trend rallies you can also make money by finding setups which will work for 3 to 5 days. And if during this counter trend rallies, if you are trying to short, then you're going to get uh, wiped out, or you're going to get like in a large drawdowns. So you have to identify periods when the risk is in your favor for shorting, and short during that period, and then go long during the periods in which money is coming in. Whenever the market primary indicator turns bearish, you need more focus on controlled risk taking, because in a normal regular market conditions you can like kind of basically have wider stops, you can have like positions for a longer period of time, but when it becomes uh, primary indicator becomes bearish, you have to really control the risk. The other way in which you can control your risk is in terms of there are times when you can let your setup run, and when there are times when you have to be taking profit very fast. So that is very critical, because if you are letting your profit run in a market where the primary indicator is bearish, you are going to see that time after time you're going to get stopped out. In that kind of a time period, you have to be tactical and take profit quickly, or like even a 3 to 5 day hold may not work. So you might have to look at 2.5, 3 days kind of a hold. So that's another way in which you control your risk. The other thing is when to do long term position trading and when to be short term tactical swing trading oriented. In the beginning of a bull market, once the primary indicator turns bullish, if you are trying to be just doing swing trading, you're not going to make as much money. That is the time when if you let positions run, then you're not going to make more money. But if in a bearish market or in the later stage of the market, if you start thinking I'll let the position run, then it doesn't work. So all in all, in order to do this controlled risk taking, experienced traders continuously assess the market conditions and the conditions for their setups, and dynamically change their rules. And this is true not only of like discretionary traders, but even people who use automated trading or those who use algorithmic kind of a trading. They are constantly assessing the situations in which they are running the algorithm, or they are operating as a discretionary trader, and accordingly they are changing their risk exposure. And this is really what is a higher order skill which you learn, uh, and that makes you profitable. The reason why many people who are not profitable or the beginners have trouble is because they are not really controlling the risk. They become very aggressive. Today morning, if you become very aggressive, you on the long side you have found out that look, that was not the best strategy. So this kind of controlled risk taking as an approach is what is a learned behavior. It's not something which you are going to get it at the day one, but as you survive and prosper in the trading world, you start developing strategies and you start developing rules and you start developing tools which will allow you to control risk taking. And once you master this art of controlled risk taking, is when you will have a smoother equity curve, and that is when you will not be bothered by the market because you are in control of the risk. So always strive for developing controlled risk taking as an approach to trading in the market.